Let me ask about the elephant in the room, and we'll get that out of the way. Your name has come up in conversation, at least, about the possibility that you might take one of the seats that's open on the Federal Reserve Board. You're a well-known economic analyst and expert in Washington. Are you in conversation or communication with the White House about that possibility?
I appreciate your asking, and I'm very pleased and honored to have my name out there. And I believe I'm being considered, and I appreciate that opportunity, but I don't want to comment in detail on the process or speculate further on that.
Just what I would say if I were in your position, I must say. But you would be open to it, I take it, I mean, from your side.
Well, I'm very enthusiastic about the strong growth, the genuine economic growth agenda that we're seeing take place in the United States. I think the results speak for themselves. We're seeing that at 3.2% growth the first quarter. We've had an important reduction in the regulatory burden, tax reform, which I think is pro-business, pro-entrepreneurship. I think we're dealing with the trade issues in a way that we have to. I think it was neglected for a long time. So for me, the fourth pillar of that pro-growth program would involve stable money. I would like to see our monetary policy support the other major pillars of a pro-growth economic agenda.
So let's talk about those two things specifically. What's going on with the trade issues, and let's call it a conflict right now between the United States and China on the one hand, and stable money and what the Fed does. How do those two things fit together? The president has been very direct about saying he would like the support of the Fed as he goes into negotiations with President Xi.
Well, it would have been easy. The easy path would have been to declare victory and say we've been triumphant and we have a new trade relationship. But I think the president was stalwart in saying, no, there were some changes at the end, and it will have all been a waste of time if we don't get some genuine changes that actually the rest of the world has been calling for a long time in terms of China's position in providing access to its markets and protecting intellectual property rights and not forcing joint ventures. For me, the currency manipulation issue has been a strong point. I think it puts us on the moral high road in saying we believe in free trade, but that means a level monetary playing field. China's able, with its state-controlled apparatus, to bring everything to bear. They can intervene in the currency markets daily. They do so as a matter of policy. They can engage in fiscal stimulus at the drop of a hat. I think it's tempting. The United States wants to fight fire with fire, but we don't do it that way here. We believe in the private sector. Right. But I wouldn't want the Fed to be a burden and to do the wrong thing at this time and undermine some of the good growth prospects that we have ahead of us.
Did it do the wrong thing in December when it raised rates?
I think by its own admission, we've seen almost a complete turnaround. So I think the Fed itself went from being quite inclined to raise as quickly as possible to now rethinking and sitting tight, and now even hinting that it could go the other way. So I welcome this newfound humility on the part of the Fed, a watchful waiting, and I think it's an admission that central bankers are not always omniscient in knowing exactly where interest rates should be. I think it would be healthier if we had a more organically determined interest rate that reflected market thinking.
Given your commitment to the pro-growth agenda, as you describe it, do you think, beyond not being a hindrance, do you think the Fed should take into account what's going on, for example, in the trade negotiations, to be an affirmative help? Should they get out in front of it and say, let's loosen up some of monetary policy to actually reinforce? Well, let's be frank, the PBOC is doing some version of that for President Xi.
Well, that's right. But I think it would be a little dangerous to want a more activist Fed. I just don't want them to mess things up. And I say that respectfully. But the point is, you don't want to undermine our position or the progress we're making. That doesn't mean that we want the Fed to start anticipating what it can do as an instrument of government policy. I think the Fed is too interventionist. I think it's the distortions that occur as a result of trying to artificially move the interest rate that can end up being more problematic. For instance, our practice of paying interest on excess reserves. We actually have, at a time when ordinary Americans on passbook savings get 0% interest, the Federal Reserve is paying banks on their checkbook accounts held at the Federal Reserve 2.35%. And that's an interest rate they're getting for doing nothing that they're not passing through to their own depositors. I don't think the Fed should be helping one segment of the economy at the expense of another segment. And so I would want to start to have a glide path toward, I mean, you don't do anything abruptly, but toward moving the Fed away from the distortions that I think hurt private sector entrepreneurialism and give banks the wrong incentive and actually make them feel like, why go through the hard work of financial intermediation and making consumer loans or helping would-be entrepreneurs when I can just let my money sit at the Fed and earn a nice interest rate for literally doing nothing.
You talked about the importance of sound money and the Fed ensuring that we have sound money. Explain a little bit of how you would do that. I mean, for example, we've had some people who've been nominated for the Fed who suggested we look at a basket of commodities prices in determining where we really are in inflation and not use the traditional indicators. What would you look to?
Well, I would first start by saying it's a different mindset. When you talk about sound money, you're now looking at money as a moral contract of sorts between the government and its citizens. Money is meant to be a reliable, meaningful unit of account. It's supposed to be a dependable store of value. It's supposed to work for everyone in the same way. There should be no monetary favoritism that helps wealthy investors or big corporations who want to do buybacks. Money should work for everyone, and it should not be causing further wealth inequality. And so that's where I would start. I think the Fed is going through a period of introspection. Its own inflation targeting approach is not achieving the results it thought. The models aren't working the way that central bankers would have anticipated. They're targeting inflation, missing the target. They're even defining stable prices in a way that I'm not sure everyone would agree. I'm sometimes called a gold bug. I guess you were alluding to commodities. I do think that there is virtue in having some kind of some monetary integrity that's not just dependent on a dozen people meeting 8 times a year to decide what should be the price of capital. So I think the Fed should be open, and I think is increasingly open to new ways of working, new mechanisms, and maybe even taking a look at its own record and deciding how it could do better.
Do you have a specific mechanism in mind in saying that? I mean, it sounds like you don't favor inflation targeting, even at a different number than the 2%, which is used now. And I was actually talking about somebody else who was nominated for the Fed who said it should be a basket of commodities, not just gold. But is there a different standard that you think would ensure sound money, as you call it, better than what we're doing now?
Well, I don't want to go and specifically recommend a commodities basket. I think we have to really think hard and long about what the rule would be. But I think the beginning of re-examining the role of central banking and whether it's helping or hurting genuine economic growth is, again, for me, to start with the mechanism. Remember that paying interest on excess reserves was adopted in October 2008 as an emergency measure. Here we are more than a decade later, still indulging in this kind of disincentivizing banks from doing what they should be doing, which is the hard work of examining a loan application and trying to gauge someone's character and their work plan and their commitment to paying it back. I think when we look around the world and see negative interest rates, largely engineered by central banks, we have to ask if we haven't even undermined the whole idea of having faith in a better future. I mean, I think that's more human nature. So I think we need a more organically determined market rate of interest. And rather than try to put the rule on it at this point or say what the new slight change in the Federal Open Market Committee approach might be, let's just start by saying, let's try to get rid of the things, slowly phase them out, maybe have a glide path of a year or two of getting rid of the harmful practices and reassess what's the proper role of central banking in a free market economy.